Let's welcome Jorge Montepeque, Managing Director, Benchmarks at Onyx Capital Group, now a fellow Dubai resident. He loves the place. I think he's joined the tourist board. It's wonderful. Jorge, meanwhile, outlook for the second half of the year. First half, you joined us a little bit late, but we were saying that oil Brent averaged $70.80 in the first half, despite all of the tumultuous events that happened. How do you see the second half? What do you think is the driving North Star for the oil price? And where do you think it'll average in the second half of the year?
I think we're being more constructive than we think we are. I think the market has tested some levels, some low ones in the upper 50s, but demand is strong. Demand in China, despite the move towards EVs, remains strong. Asia is good. Africa is good. Latin America is good. The US is good. Europe is still good. The supply, as we have been discussing, is not what we think it is. There has been so much supply management in the narrative by OPEC that it's very difficult to do the actual quantification of what supply and demand is. And I am very glad that OPEC seems to be increasing the quotas, because it's bringing the actual narrative to where the production has been, so we can actually do real numbers. So the growth in demand has been a little bit stronger than I think we all have been thinking it was. And this means that prices are in a slight uptrend.
When you say growth and demand, sorry, Jorge, I just want to sort of drill into that a little bit. The traditional critical pillar of global demand, obviously for 30 years, has been China, all else remaining the same, US, Europe, etc. Is that what you're referring to when demand in the first half has been better than expected? Are you pointing particularly to China?
No, I am pointing to the rest of the world. I think the growth areas in Africa, in Latin America, Central Asia have been stronger than we thought. They continue to grow. Population growth is looking good in all those rest of the world areas, and they consume hydrocarbons. I would consider Europe, the US, and China as mature economies, which they are. And those areas, of course, we probably were so bearish initially on China. We still are, because there's a move to EVs. But the demand from the rest of the world and the US is not as bearish as we thought it would be. And this means that since there is not a lot of supply coming in from OPEC, then prices are more constructive than initially we were thinking. So we are now in the mid-60s, which for the summer burn seems between what should be the average to maybe a little bit below the average. So what I'm trying to say is we may see surprises to the upside here onwards towards the end of the year. The only negative, and we need to look at that very closely, is the impact of the tariffs, because Trump creates so much chaos effectively. The economies could start falling off, and housing starts in the US are already dropping. And if that continues, then Q4 could prove more disappointing than we think it is. So it all really resides in the US. If the US comes down and focuses on growth, as they said they would, then we're going to see an environment between the 70 and 80 for the rest of the year. And I think as it is, we're still heading towards the 70, if not a little bit higher, over the next few months, pending what happens in Q4 in the US economy.
Jorge, just looking at those points, I wanted to get some of your sort of technical expertise on the market and taking some of the comments that Aaron and James has mentioned. Aaron mentioning the confusion of the market in the context of quotas are increasing, but supply isn't, which would indicate perhaps that and the numbers and reporting of secondary sources and people's misunderstanding prior to these increases in quotas of what actual production was, so that the expectation, oh, you're rising quotas, you're going to be rising supply and so forth. And last year we saw OPEC forecasting to be way ahead of where IEA forecasting was. And now this year we're seeing questions are emerging around, are the secondary sources getting it right, in which OPEC and the market depends a lot on. I just wanted to get your views on some of those things. That part of the reason the markets have been subdued with these OPEC increases because the data and the reporting isn't quite where the reality is.
Yes, the data that the secondary sources and OPEC report that each member is producing is largely wrong. These figures do not represent the actual output capacity of these countries. This is a matter of great debate, but every time we poke at any number, it is understated by the secondary sources and by OPEC. And at the top end, in terms of understatement, is the production by Abu Dhabi, followed by Iraq, and off you go into every single member, including the plus members. In our analysis, the only two countries that are sort of respecting the quotas are Kuwait and Saudi Arabia. But even Saudi Arabia in the last three to 4 months has been increasing the production over and beyond the reported quota. So when any narrative comes out of OPEC about we are increasing the quotas, really, frankly, to all the viewers, ignore it as a statement.
Why are the secondary sources getting it wrong? I mean, they have access to a mountain of very transparent data in the world today. What's your analysis on why these numbers are being incorrectly reported?
The secondary sources are subject to a huge amount of pressure by OPEC members to toe the line and reflect some fantasy. And this goes to even the big producers. And one of the secondary sources, even has two streams of data, one that is produced for OPEC and one that is produced for analysis. So really, really take the whole lot and just put it in the bin. Ignore it. It's irrelevant and it's wrong. What you need to look back or look forward right now as to what is coming in is really what Saudi Arabia is adding to the market. I checked with some of my sources as recently as last week, and they have been dribbling out. They first did a chunk of about 125 KBD 1 month, about 3 months ago, and then they have been adding close to 50 KBD a month. So they're doing it slowly, dribbling. And this is continuing into Q3 and will continue into Q4. So the Saudis are managing the increase very carefully, very effectively, and almost unnoticeable by the market. So they're feeding that growth that we see. But the rest of the other producers are producing as much as they can. The narrative, therefore, is totally useless. And anybody who uses the OPEC narrative to do analysis is just getting it wrong. And this is what caused us to become more bullish initially, reverse where we were seeing the world, because we saw the world absorbing the extra production by OPEC. So the market looks healthy.
Jorge, last word with you on, again, looking to the second half where, we mentioned earlier, we believe that the price already is bedded in that OPEC Plus will continue with this accelerated increase. Has it also bedded in the big sort of moment that's coming next week, which is the expiration of the suspension of the Trump tariffs, and now coming back into the headlines every day now that he's going to unilaterally declare, send a letter to everybody and tell them what their new tariff level is? Is that an event that was incredibly turbulent for the markets in April? Does it return to be as turbulent, or are we back at taco here?
The market gets accustomed to anything and everything.
Complacent or accustomed?
Accustomed. We all get accustomed to anything. So the shock value of the tariffs has worn off. And by all indications, Mr. Trump will say something like, let's keep on talking about it, or he'll do a taco thing, a reversal that we will soon forget. But what it all means beneath it all is that the budget situation in the US is very precarious. So the big thing heading towards us, and all the different speakers have addressed it, is that inflation is coming because the US has to print. They have so much debt that they need to sell.
And they're about to pass a budget bill that's going to add apparently another $3 trillion on that.
Correct. And the dollar is tanking. The dollar is really falling hard. This is the inverse of that, is that it's very positive to commodities, of which oil is one of them, because there's too much currency chasing for the goods. So even if the market is not as strong on a demand point of view basis, because there's so many dollars in the system, the price is constructive. So all of these things are pointing out to maybe some nice surprises to the Middle East, which is so dependent on the price of oil. And the other thing we need to factor in as well is that by all indications, the ceasefire between Israel and Iran is largely holding. The pressure is not to play further, so to speak, because it's so expensive. Your organization put out the article about Qatar explaining how expensive and damaging the attack was. All of these things result in perhaps more stability in the system. Stability is good because it leads to more consumption, but the US is unstable, but the instability is reflected in more currency, and that is also positive for the oil business.